Netwealth webinar on Value Investing 101, How, What and When. I've got Roger Montgomery here with me from the Montgomery Investment Management. First, a couple of housekeeping items, including getting the webinar system to get going. Here we are, a couple of housekeeping items. This webinar is being recorded. If you have any questions, please enter them in the question box. We'll endeavour to answer them in the question and answer section at the end. Hopefully we can get through all your questions. If not, we'll endeavour to answer them after. And if you're using social media or Twitter specifically, you can tweet using those hashtags. As always, this presentation is general advice only. It's not intended to be personal. If you do need personal financial advice, please seek a personal financial advisor. Today's presenter is Roger Montgomery from the Montgomery Investment Management team. He's the Chief Investment Officer and founder of Montgomery Investment Management. He's also an author of the best-selling book Value Able. And previously to founding Montgomery Investment Management in 2010, Roger held positions at Ord Minnett, BT Australia and Merrill Lynch. Thanks for joining us, Roger.
Oh, it's a pleasure, and thank you for having me. I'm really looking forward to today's presentation. We're going to spend a bit of time helping investors understand what it is that they should look for in a high-quality business, what they should look for in terms of value, and then what we'll do is talk about whether or not there's any value around at the moment, and if there are any dangers around the corner that we should be aware of. I'm looking forward to your questions. We'll have some time hopefully at the end of the presentation to answer as many of those as we can, and I'm always open to a difference of opinion and view, so if you've got a contrary view or opinion that you'd like to submit, don't be afraid. I'm more than happy to address those and take on the challenge. Okay, we'll skip straight to it. It's very important to understand that this is not a promotion of our funds, although I'd be absolutely delighted if everyone attending today, and I notice there's quite a number of attendees. I'd be delighted if you were to invest in the Montgomery Fund. But in the absence of that, this is a chart just to show you that what I'm going to present today actually works. Montgomery is there compared to a bunch of other fund managers, and what you'll see is our performance since inception at the top of the chart, and that has been achieved with about an average of about 20% of the portfolio held in cash. Now, cash, of course, doesn't generate a very high return, low single-digit returns, and so cash actually drags our fund's performance down. So the performance would be much higher had we been fully invested, but nevertheless, it's very important that we focus on preserving investors' capital, and that means holding cash when we can't find a sufficient number of high-quality businesses that are cheap. Perhaps more importantly than this chart shows you something which I think is essential to understand, and it is this, that by focusing on high-quality businesses, only buying them when they're cheap, and making sure that if you don't find high-quality businesses that are cheap, you hold cash. That's the next best option. What that delivers is a very palatable return profile. It's all very well generating 20% a year or 25% a year or 15% a year, but if the returns are incredibly volatile and you're going down more than the market when the market goes down, it's unlikely you're going to stick to that particular strategy. So Montgomery on this chart is the green dot or the green sphere over on the left-hand side, and if you draw a line horizontally out to the vertical axis on the left-hand side, you'll see it corresponds to a number of about 96 or 97%. And what that means is that since the inception of the Montgomery Fund, in any month where the market has risen, Montgomery has captured about 96 or 97% of that upside movement in the market. And if you drop a vertical line from that green dot, it intersects the horizontal axis at about 51 or 52%. And what that means is in any month where the market has actually declined, the Montgomery Fund has captured only about 51% of the downward movement. And that's ideal. What you'd really like is an investment that goes up when the market goes up, but doesn't go down when the market goes down. And the Montgomery Fund, using the techniques and the style and the sorts of investments we're going to talk about today, has actually achieved that. It goes up when the market goes up, but doesn't fall as much when the market has fallen. That's been the experience so far. Okay, here's the agenda for today. We're going to explain how we've achieved those returns and explain how you might think about achieving those returns as well in your own investing. So the first thing is we're going to talk about a framework. We're going to talk about what is the philosophy, if you like, of the investing process. We're going to talk about how businesses create and destroy wealth. We'll talk about probably the single most important or most popular theme in investing today in equity markets, and that is chasing yield and what the dangers are there. And I'm going to show you mathematically why that is a very dangerous thing to be doing, to be focused on, for example, large cap, mediocre businesses that are generating, the only returns they're generating are through their dividends. Then we're going to migrate across to exploring where we are now, and then we'll talk about a couple of high quality businesses and we'll name them, and we'll talk about why we think their outlooks are promising. Okay, so the framework is very, very simple. We're buying businesses, not stocks. Now that doesn't sound very significant, but it isn't just semantics. It's important that you understand there is a very significant difference in your approach to the stock market when you stop thinking about stocks and start thinking about businesses. For example, most stock market investors are simply betting on up and avoiding down. They're betting on the ups and the downs of the stock prices. They believe that they're good investors when their stocks go up, and they believe that the businesses that they've invested in are doing well when the stocks go up. But betting on up and down is actually gambling. It's not investing. So we prefer to think of the stock market not as a place where we can bet on the ups and downs, but as a place where we can buy pieces of really great Australian businesses that are expanding overseas, that have growing market share, that have amazing economic performance. So we're looking for those businesses. And if you think about the other implication, there is an interesting evolution that's occurred in funds management in Australia, where many investors will call themselves small cap managers or micro cap managers or large cap fund managers. That doesn't make sense to us because we're investing in businesses. If we see an outstanding business that has a market cap of $300 million, we want to own it all the way up to $30 billion, where we don't want to sell it because it's suddenly become too big. And we also don't want to be restricted from buying businesses that others might consider too small. It makes no sense. Once you start thinking about owning businesses, all of those rules and those constraints, they fall down. So we're regarded as an all-cap manager because we're willing to find high-quality businesses no matter what their size. The other thing is that we're looking at value. We're not looking at price. We're interested in what a business is actually worth rather than what other people are willing to pay for it. Just because the price of a company's shares go up doesn't mean it's a high-quality business. And if it is a high-quality business, it doesn't mean you're going to make a great return. It's important that you don't pay any price for a business. You have to pay a price that is less than its intrinsic value. In essence, we're looking for 3 Ps. A premium quality company, and I'll talk about what that is in just a moment. We want a business that has bright prospects. A simple question that we often ask internally is, can this business be 3, 4, 5, 10 times bigger? And if so, how many years will it take to get there? So we're looking for a business with bright prospects. And as I just said a moment ago, we're looking for an attractive entry price. We're looking to buy it at a discount to our intrinsic value. If we can find those 3 things, high quality, great value and bright prospects, that's an ideal candidate for us. It does require discipline, and that's something that investors absolutely need in their process and their framework, because if we can't find high quality businesses that are cheap, that have bright prospects, well, we're going to simply hold cash, and that could mean we're going to underperform the market when the rest of the market goes up. That's okay. We actually don't mind underperforming a market because we know that this approach works over the long run. So ask yourself the question now, are you actually gambling on up or down, or are you buying high quality businesses? Betting on up or down is no different to betting on black or red at the casino, and many investors who trade stocks, their returns are often exactly the same as their returns from going or attending consistently a casino. So my proposition to you today is think about the stock market not where you can bet on things that wiggle on a screen up and down, but where you can buy or have access to very high quality businesses. Now, the best businesses to own are simply this: businesses that can retain large amounts of their profit and generate very high rates of return on that incremental equity. That's what we're looking for. It's very simple. We want a business that can grow by retaining a portion of its profits, and as its equity grows, it doesn't dilute its return on equity. It can maintain a very high rate of return on equity. We call that a high rate of return on incremental equity or incremental capital. And businesses that can do that consistently do very well for their investors because their stock price over time can't help but follow that performance. Now, in order to achieve that, in order to generate high rates of return on incremental equity over a long period of time, businesses need to have a competitive advantage. And competitive advantages, there are competitive advantages that last a long time. For example, monopolies, they generate very high rates of return on equity. Oligopolies are the same, such as we have in the Australian banking sector. Duopolies can last a very long time, albeit they don't always generate high rates of return. Then you've got other competitive advantages such as the network effect. And the network effect is perhaps best displayed by a company like REA Group, where more people will list their home for sale on REA because more people are looking for homes for sale on REA. And more people are looking for homes for sale on REA because there are more homes listed. So you have this virtuous circle, it's called the network effect. It can be a very, very powerful driver of high rates of return on equity, but it's not, the jury is out about whether that's going to last as long, for example, as a monopoly or a geographic monopoly, for example. So time will tell, but what we want is high rates of return on equity. They have, over a long period of time, they can only be generated by a competitive advantage. I've given you some examples of competitive advantages, but perhaps the most valuable of all is the ability to charge a higher price for your product or service without a detrimental impact on unit sales volume. And an example of a business that can actually do that is, again, REA. So on the 1st of July this year, REA raised the prices of their depth ads or their highlight ads, which is a type of premium ad if you want to have your property featured on REA. They raised their price. And they're not going to see any decline in the number of listings due to that. There has been a decline in listings, and we'll talk about REA later on. There has been a decline in listings, but that's largely because we've been in a year where we've had an election. People tend not to sell properties in election years, and certainly during the campaign period and the election itself. And so there's been some decline, but it's not because they've raised prices. I'll talk more about that later on. So another example I can give you is Tiffany's, for example. Now, they charge more for their diamonds than just about anyone else, even though you could buy the same diamonds from a merchant on this side of the street. Tiffany's charges more, and yet people are encouraged to cross the road and buy their diamonds and jewellery from Tiffany's. Now, why is that? It's because they've got a reputation, they've got history. They had Audrey Hepburn in a movie, Breakfast at Tiffany's, and so there's a mystique and a prestige associated with the brand. And what's great about that is it means the company can charge more for its product and generate higher returns on equity for a sustained period of time. And what's interesting about that is the things that drive its competitive advantage aren't easily replicable by somebody else. So that's the sort of thing that we're looking for to drive those high rates of return on equity. We're always asking what those competitive advantages are and whether they're strong and long-lasting. So that in essence is the framework. 3 things to focus on: high quality, great economics. We talked about economics, and we're going to talk about those economics again in more detail in just a minute. We want value, and we want bright prospects. They're the 3 things in essence that make up our framework. And overarching all of that is to approach the stock market as if you're approaching buying a business rather than gambling on black or red or up or down. Now what we're going to talk about is how businesses create and destroy wealth. This quote that I've got here by Warren Buffett in 1982 is, I think, one of the most important quotes from Buffett, but one of the least reported. I wrote a book called Valuable in 2010. It became a bestseller, and I attribute that, and maybe I'm wrong, but I attribute that to the exploration and understanding of this particular paragraph. I'm going to talk about this particular paragraph now and explain what I think it means. If you miss it because we go too fast, well, you'll be able to listen to a recording of this presentation, or I'd encourage you to buy a copy of Valuable and understand it from that as well. So here's the quote: "Growth is good only when each dollar used to finance the growth creates over $1 of long-term market value." So there's good growth and there's bad growth. Now that might surprise some people. Let me explain what I think Buffett meant. Here we've got a table, and in the table I'm describing a business, I'm describing a company. You can see in year 1 the company's got $10 of equity per share on its balance sheet, equity being the assets minus the liabilities of the company. It's generating a very high rate of return on equity of 20%. So in year 1, the company generates $2 of earnings per share. You can see that in the 3rd row in column 1. The company pays none of the earnings out as a dividend. And by the way, that's a very sensible thing to do, because if the company can generate a 20% return on the money, I don't want it as a dividend. Don't give it to me. I'm not going to get 20% on the money. I'd rather the company keep it and generate 20%. And that's what Warren Buffett has done at Berkshire Hathaway for 50 years, generated about 21% return on incremental equity. So this company's paying no earnings as a dividend. As a result of there being no dividends, the equity grows by the amount of the earnings that are retained. In this case, 100% of the earnings, which were $2, so the equity grows from $10 to $12. And you can see the equity at the end of the first year is $12, and the equity at the end of the first year equals the equity at the beginning of the second year, which is $12. And you can see in the second year, the company generates 20% return now, not only on the original $10, but on the $10 and the $2 of incremental equity, the retained earnings from the previous year. So now earnings grow by 20% as well. So the earnings have grown to $2.40. Now let's stop there for a minute and let's go down to the stock market, which is the bottom 2 rows, and let's make the assumption that we don't know when the popularity of this stock is going to change. We don't know when the stock will be re-rated or derated, and so we're just going to assume the PE ratio remains constant. And in this case, we use a number of 10. Now what you'll notice is that in year 1, the shares trade at 10 times $2, which is $20. If the PE ratio remains the same and the earnings grow by 20% because 20% was earned on the incremental equity, then the shares will trade at $24. So let's just go back one step and look at this Buffett quote again. Growth is good when every dollar used to finance the growth creates over $1 of long-term market value. Now what you'll notice on this table is that $2 was used to finance the growth. So the company earned $2 and it retained all of that $2. What did this business turn the $2 into? It turned it into $4. So this meets the criteria that Warren Buffett was talking about. This company retained $2 and converted it into $4 of additional value. This is why you want to own businesses with high rates of return on equity, and this is why you don't want a dividend if a business can generate a high rate of return on equity, because it can convert every dollar of retained earnings into $2. Contrast this example with the next example. Everything's exactly the same here, except the return on equity is 5%, not 20%. And in this example, what you see happens is that the company earns 50 cents on the $10, which is just 5%. It retains all of those earnings, so the equity rises from $10 to $10.50. And then it earns 5% in the second year, which happens to be 52.5 cents. I've rounded it up here to 53 cents. So if we multiply those earnings by 10, we find the shares rise from $5 to $5.25. So the question is, how much money did this company retain for growth? It retained 50 cents. How much did it convert that 50 cents of your money? Remember, this is your money. You could have received this as a dividend, these 50 cents, but the management decided to retain this and keep your money from you. How much did they convert your 50 cents into? 25 cents. They've actually lost half your money. So I think that's a really important point. There's good growth and there's bad growth, and good growth is a company that generates high rates of return on equity while growing its earnings per share. Bad growth is a company that increases its earnings per share, but it does it with a low rate of return on equity. If you read enough about the best investors in the world, not just Warren Buffett, but Seth Klarman and so many other value investors who through history have generated extraordinary returns, what you find is that they focus on a number, and the number that they focus on is return on incremental equity. These are the sort of economics that we don't like, and the example that I gave you earlier with 20% return on equity, that's the sort of economics that we do like. Now, let's look at a real example. Let's look at economics another way. I want you to imagine for a moment, it's 2005. I've taken some numbers from a real company that's listed on the Australian stock market, and I've taken 2 years of annual reports, and I've taken those numbers directly from the annual report for 2005 and 2014, but we can use 2000 that shouldn't be 2015 at the top, by the way. That's the incremental difference. We'll use 2015. So imagine for the moment it's 2005 and I ask you to invest in a business. And the first thing that I ask you to do is to reach into your pocket and write a check to kick the business off. I'll run it, you own it, and kick the business off with $400 million of equity. You can see that in the middle highlighted row there, equity put in. So that's the equity contributed by the shareholders, in other words, the owners of the business. This is what you've put in to kick the business off, $400 million. Now, we'll also run down to the bank, and you can see in the bottom, the penultimate row down the bottom there that's highlighted with the red, $820 million. So we also go to the bank and we borrow $820 million to kick the business off. So you've written a check for $400 million and we've borrowed $820 million, and you leave me to run the business now. And in the first year, I generate a profit of $165 million. Now you're absolutely delighted with this turn of events, because $165 million on the $400 million that you've invested is a return of almost 40%. It's about 40%. So you say to me, Roger, that's absolutely fantastic. I can't get 40% in a bank account. I want you to keep running the business for 10 years. I'm off on a holiday and I'll see you in a decade's time. So I start running the business. Now, one of the things that I did before you went is I made sure I had a power of attorney so that I could actually dip into your bank account, because I want to grow the business and I might need some additional capital to actually grow the business. And that's what I've done while you were away. So if we fast forward to 2015 and we look at the middle highlighted row there, you can see you've now contributed $1.15 billion of your own money into this business. You originally wrote a check for $400 million, and since then you've put in another $750 odd million of additional capital. Now that's because we've expanded the company geographically, we've moved overseas, we're servicing more people, and that means we need more plant, equipment and machinery to service those customers, and as a result that requires more money. So I would argue we've grown the business. But if you look at the top line, you'll see that profits have actually declined. 10 years ago you were generating a profit of $165 million, and in 2014 you lost $317 million, and this year, 2015, you lost almost $50 million. None of those numbers, by the way, are very impressive, and they're particularly bad because you've put more money in. So 10 years ago you injected $400 million to make $165 million. You've now injected almost $1.2 billion of your own money, and you're now losing money. You are going backwards at a rapid rate of knots. In fact, if you just put the additional money in a bank account and bought yourself a rocking chair, that's all the equipment and plant you needed to generate a better result. This business, with all the plant, machinery and equipment that it's got, and all of the experts running the business and all of the staff running the business, have done a worse job than a bank account. But by the way, the picture gets a lot worse. If this was your business and you returned after 10 years holiday, the next question that you would ask me is, Roger, okay, I'm not happy, but please tell me we paid off that $820 million that we borrowed 10 years ago. And look down the bottom there, you now owe the banks $2.5 billion. So this is an unmitigated financial disaster if this was your business that you owned outright, and you'd be wondering, you probably would have sold this business a long time ago or wound it up. This is actually a real business. It's a business that's listed on the Australian Stock Exchange, and the business is Virgin Australia Holdings. This is an airline. Warren Buffett once said he would never buy airlines after his experience with American Airlines many years ago. Now, let me say this. You've heard it said you should invest for the long run. But if you invest in a poor quality business, what you will find is that the shares will follow the performance of the business. This is the long-term performance of the shares for Virgin Australia Holdings. And it doesn't matter, it's not quite up to date, but if I updated it to now, the same thing would be true. Back when the company listed, it listed in 2003. It listed around the $2 mark. By 2003, 2004, it had traded as high as about $2.50. Then, of course, the share price has followed the economic performance of the business. I think it now trades around 40 cents or around that level, and I'm not surprised given the performance of the business. That's why we focus on businesses with attractive economics, high rates of return on equity, and the ability to sustain those high rates of return on equity for a very long period of time. If we don't invest in those businesses, then over time we will find the performance of our funds will be poor because the performance of the underlying investments will be poor. Benjamin Graham said, in the short run the market is a voting machine, but in the long run it's a weighing machine. And I want you to remember that, because in the short run the share price of Virgin shares, they can go up. If the oil price drops, they might go up. If people believe there's going to be a takeover of Virgin, the share price will go up. But is it a high quality business? In my estimation, and using our framework, we wouldn't say it's a high quality business, and as a result we wouldn't want to buy the shares. Now, here's another quote to remember. If you're not prepared to own the whole business for a decade, and looking at that you wouldn't, then don't own a share of the business for 10 minutes. And I think that's a good framework and a good philosophy to abide by. Okay, so we've talked about how businesses now create and destroy wealth. What I want to do now is show you how I think investors run the risk of destroying some of their wealth over the next couple of years by chasing yield. If you've got $1 million in a term deposit today, you're earning 2%. That's about $20,000. In fact, it is $20,000. It might surprise you to know that that's lower than the poverty line in Australia for a couple. What does that mean? That means if you're a millionaire and you've got $1 million in a term deposit, you're impoverished. You are, in fact, on an income basis, earning less than somebody who is below the poverty line in Australia, or at the poverty line in Australia. As a result of an income recession in Australia and around the world, investors have been migrating up the risk spectrum and investing in businesses listed on the stock market because they pay a more attractive yield. There's a danger to doing this, and I'm going to show you what that danger is. You've seen this table already. I'm going to use it now to describe a different scenario. Here we've got a high rate of return on equity of 20%, but you'll notice here the board of the company has increased the payout ratio. In the previous examples, the payout ratio was 0. In this example, the payout ratio is 100%. In other words, the board of the company has decided to pay all of the earnings out as a dividend. Okay. That seems to make sense, doesn't it? In a world where income is low from term deposits, if a company can pay all of its earnings out as a dividend, that seems to be an attractive thing. And boards around the world and in Australia have acquiesced to shareholder demands for more income by increasing the payout ratio. In Australia, since 2010, the payout ratio for the ASX 200 has risen from about 55% to 80%. And in the United States, on the S&P 500, the payout ratio since 2010-2011 has risen from about 27% to about 60%. So around the world, payout ratios are going up. That seems to make sense, but let's see what the consequences are. So here we've got a company with $10 of equity, earning a 20% return on equity, which is $2 in year one. The company board decides to pay 100% of those earnings out as a dividend, and as a result, all of the earnings are paid out, and you can see the dividend per share there is $2. Now, because all of the earnings are paid out as a dividend, you can see that the equity doesn't grow. The equity at the start of the year was $10. The equity at the end of year one is also $10. And across the top, year one, year two, year three, there's no growth in the company's equity. And because the ROE, or the return on equity, stays the same at 20%, admittedly attractive, but nevertheless unchanged, the earnings don't grow either. Because the earnings aren't growing, the dividend isn't growing. And because the dividend isn't growing, your income isn't growing. Guess what? This is a bond. This is exactly the same as a bond. I'm describing a company like Telstra under Sol Trujillo in 2005, paid 100% of the earnings out as a dividend. So we've now described the business. Let's look at the bottom half of this table and look at the stock market. Let's make the assumption that we're no good at predicting when the popularity of the company's shares are going to change. So we'll just make the assumption that whatever PE we buy the shares on is the same as the PE we sell the shares at. And so in this case, I'm just going to use 10. So the PE ratio we buy the shares for is 10 times next year's earnings. So next year's earnings in year one, next year's earnings are year two earnings of $2. So we buy the shares for $20, and that's an outflow of cash of $20. And you can see that in the penultimate row there at the bottom. In year two, we receive a dividend of $2. And in year three, we receive a dividend of $2, and we sell the shares for 10 times the following year's earnings, which will also be $2. So we sell the shares for $20. Now, why am I telling you this? What's important about this? Well, it's more significant than you might initially realize. The internal rate of return of those cash flows is 10%. Coincidentally, well, perhaps not coincidentally, that return is equal to the dividend yield when you bought the shares. So the dividend yield, when you bought the shares for $20, the dividend was $2 in year one. That's a dividend yield of 10%. Why is that important? Well, the reason why it's important is this. That is the highest return you are going to get as an investor in this business. Your return is limited on the upside by the dividend yield. Now, 10% is attractive, but this is only a hypothetical example. In the real world, people are buying stocks today, equities, on yields of 3% and 4%. And if the payout ratio is 100%, that's their maximum return. The only way you're going to get a higher return than the dividend yield when you bought the shares is if the PE ratio expands. But in order for you to predict that correctly, it requires you to speculate. And because we're investors, not speculators, we don't think we're particularly good at that. So the only way you're going to get a higher return is if you correctly gamble that the popularity of the stock is going to rise in the future. There's a very real danger that the popularity of the stock declines in the future. Why? Because the share price is expensive and the dividends aren't growing. So if interest rates go up, that dividend yield on which you bought the shares is not going to look as attractive. And guess what? The share price could actually come down, meaning the PE goes down, not up, and you end up with a lower return than your dividend yield. So a lot of investors have been piling into what are conventionally described as blue chip stocks, believing that they're going to be safe, and in actual fact, they could potentially lose a lot of money. And let's say they don't lose a lot of money. Let's say that things just plod along as they have been. What are you missing out on by investing or concentrating your investments in very large cap, blue chip, low growth but high dividend yielding stocks? What you're missing out on is this. I've got 3 stocks here on this table. I've got Telstra in the middle, I've got CSL on the right, and M2 Telecommunications on the left. Now, let me say at the outset, in the Montgomery Fund and the Montgomery Private Fund, we have never owned Telstra shares. We do own CSL, and we've owned it for a long time, and we have owned M2, but at the end of last year it was taken over by Vocus. What would happen if you put $100,000 into each of these companies back in 2005? Well, $100,000 in Telstra, which was generating an average return of about 25 or 26%, but paying 100% of the earnings out as a dividend under Sol Trujillo, $100,000 10 years later has grown to $117,000, just keeping up with inflation. And look at your dividend yield. In 2005, Telstra had the highest dividend yield of the 3, 5.97%. So on $100,000, that's income of $5,970. Fast forward to 2015, 10 years later, and that income's grown to $6,500. That income has not kept up with inflation. Whatever restaurant you could afford to eat at in 2005, you can't afford to eat at that restaurant today. Contrast that, and I'll use one example, contrast that with M2 Telecommunications on the left-hand side. Very similar return on equity, mid to high 20% returns on equity on average over the last 10 years. But the difference is this is a company that's been able to retain large chunks of its profits and grown at its equity and continued to generate high rates of return on that growing equity. $100,000 in M2 grew 30 times over 10 years to $3 million by the end of 2015. Now, that's impressive, but what's even more impressive is that people think that we are, at Montgomery, growth investors, that we invest in growth stocks, not income stocks. But have a look at the income. 10 years ago, M2 was generating a yield of 3.91% or $3,910 for every $100,000 you invested. Fast forward 10 years later, and it's generating a yield of 99.8% on your original $100,000 investment. You're now generating annual income that is almost the same as your original investment. Isn't that what you want from your investment? Now, is this an income stock or is this a growth stock? Guess what? It's just a great quality business. If you invest in high quality businesses that have the economics that we've described, this is the sort of outcome that we're expecting. And these, visually, the next couple of charts here that I'm going to show you just demonstrate that there is a very strong correlation between income growth and the share price. So we're not looking for high yields, we're looking for high income. So here's M2 Telecommunications. Here is CSL. Again, good correlation between the green line, which is the income growth, and the share price. And have a look at Telstra. There's Telstra's income growth. There's been very little of it over the last 17 years. And unsurprisingly, the share price today is lower than where it was in 1999. Is that a high quality, is that a blue chip investment when after 17 years of investing, the share price is lower than where it was 17 years ago? I don't think so. We think we need to redefine what blue chip actually is. And a blue chip company is a company of any size that can retain large amounts of its profit and generate high rates of return on equity for a long time in the future. That's a true blue chip. It doesn't matter what size it is. Okay, so we've talked about our investing framework. We've talked about how companies create and destroy wealth. And if you're still following us closely, you are doing extraordinarily well, because in 45 minutes we've covered what we could do in a semester in a course on value investing. You're doing very well to follow. Okay, so now what I'm going to do is I'm going to switch gears and I'm going to talk about where we are now economically, and I'm going to summarize it with this table here. A lot of investors, when they think about what the future holds, they look at the last 20 or 30 years and they say, well look, if I'd behaved this way in the last 30 years, I would have done really well, but the next 30 years is going to be very different to the last 30 years. 30 years ago, back in the 1980s, early 1980s, we had historic high interest rates. Since then, interest rates have been going down. They've fallen for 3 decades, to the point now where US 10-year Treasury notes are trading at a yield that is less than where they were during the Great Depression. Now, that's not a reflection of the economic circumstances of the world. It's a reflection of central bank buying of bonds that have pushed yields to this level. In other words, they've been created synthetically. It's an artificially low rate. And that, in the last 30 years, has helped businesses grow their profits. They've grown their profits because they could borrow money and their interest expense was going down for 30 years. Corporate profit margins over that time increased. They increased not only because interest rates were going down, but they also increased because productivity improved. What did productivity improve through? Well, in the late 1980s and the early 1990s, we had the advent of the internet. Mobile telecommunications quickly followed. That increased the productivity of employment. The other thing that happened is companies 30 years ago had very low debt. So they had a long runway of credit expansion. They could expand their balance sheets by borrowing money. Interest rates were going down. They could employ more people, and by employing more people, and those people were becoming more productive, they could increase their profits dramatically. And that's what's been happening for the last 30 years. But over the next 30 years, we have arguably the opposite situation. Interest rates are already historically low. They're probably going to rise in the future at some point. By the way, people often think that what they see now is the new normal, that it's always going to be like this. I remember, for example, during the internet boom in 1999, people ran away from dividend-paying stocks. And the reason why they ran away from dividend-paying stocks is because they wanted to invest in high-growth businesses. What's happening now? The reverse. They're running away from high growth businesses and investing in dividend paying stocks. In both circumstances, share prices were pushed higher. But how can it be? Because what we've got now is we've got interest rates likely to move up. We've got corporate profit margins now being competed away. We've got productivity actually declining. We've got companies now with extraordinary amounts of debt that they've accumulated not to grow their businesses, but to pay special dividends and buy back their shares. So we've got enormous amounts of debt. There's going to be a period of deleveraging. Companies aren't going to be borrowing more money to grow. They're going to actually have to pay down their debt. And now we have a demographic tailwind as well. We've got arguably more dis-savers in the world than accumulators. So we've got people selling assets to fund their retirement, where previously that demographic, the baby boomers around the world, were accumulating assets to fund their retirement. Now that they've accumulated them, those assets, they're starting to sell them. So that could put pressure on asset prices around the world. All of this means that you really need to focus on growth in order to generate alpha. Another way, of course, you can generate alpha or generate additional returns is by looking for funds that have the ability, for example, and this you need to speak to your advisor about this because some people can and do believe that it's higher risk, but one way of creating alpha is to short sell or to look for market neutral funds and those sorts of things. Okay, this is the slide I want to show you. Here's a really neat picture of the S&P 500, the blue line, against 5-year Treasury interest rates in the United States. What you'll see, let's go back to 1981. Low interest rates ahead, so interest rates were falling, and I've just described how that was going to be a tailwind for companies. We had companies growing their borrowings. They were increasing their borrowings over time because they didn't have much debt, and productivity was going to improve. Did you know that with all of that ahead, which was obviously going to be a great time to invest in companies, you could buy the S&P 500 in 1981 at 7 times earnings. It was clearly a brilliant time to invest. Turn to 2016, we have exactly the mirror opposite image. Higher interest rates ahead, credit cycle has ended, the expansionary credit cycle has ended, productivity is likely to be declining, the US economy is already near full employment. If you've got full employment with declining productivity, that means corporate profit margins are likely to be under pressure. And Hillary Clinton has already said she wants to increase the minimum wage in the United States from about $7.50 to circa $12. That's a 70% increase in the minimum wage. Think about what that could do to corporate profit margins in the United States. And now the PE ratio is not 18 times on this slide, it's actually now 20 times after the more recent rally in the S&P 500. So I would argue it's the time to be very careful about where to invest and to make sure you're not investing blindly in those big lumbering mediocre blue chips. Okay? And very quickly, talking about a couple of blue chip businesses that we like, and I'll have to go through this so that we've got enough time to answer a few questions. I want you to remember this. If you're investing in high quality businesses, time is your friend. If you'd bought one share of Coca-Cola at $40 in 1919 when it listed, and then held on through the sugar crisis of 1920 when Coca-Cola's shares halved, then held on through the Great Depression, then held on through World War II, then held on through the Vietnam War, the assassination of Kennedy, the Cuban Missile Crisis and so forth. If you'd held on to that one $40 share, you would now, and by the way, took all the splits and reinvested all the dividends, your portfolio of Coca-Cola shares is now worth about $12 million US. So it makes a lot of sense to stay invested through thick and thin in high quality businesses. And here's a couple of high quality businesses. The first one is REA. REA is growing the proportion of ads that are described as depth ads. So they're the highlight ads and the premier ads. And you can see over time that the combination of the two is increasing dramatically. Yes, of course, there are cycles and they go up and they go down, but over time, I believe in a maturing property market. We're no longer in a booming property market where, by the way, in a boom, a lot of properties were never listed for sale because real estate agents could find buyers straight away and they didn't take very long to sell. In a mature property market, you're going to have to advertise your property for sale. So there's arguably going to be more properties listed, and we believe in order to sell your property, you're going to have to feature it. You're going to have to compete to sell in a mature property market. And that means not only more listings, but it also means more of the more expensive premier listings. So that's potentially growth on growth. What we know is that REA's depth listings in August were 10% higher than the same week a year earlier. The highlight listings were slightly above the same time last year, but the more expensive premier listings were almost 40% higher than the same time last year. REA is not only getting growth from the number of people listing their properties in a mature property market, they're not only likely to get growth, and that's our view, by the way, that will happen. They're not only going to get growth from a greater proportion of premier ads and highlight ads, we also think they're going to get growth by continuing to be able to raise the prices of their ads. Now, in Australia, last year, $6.5 billion was spent advertising or marketing residential real estate in Australia. Of that, real estate agents took 85% and REA took 5%. Now, we believe that REA delivers more than 5% of the value in a transaction, and we believe real estate agents deliver something less than 85% of the value. Now, I don't know what that number is, but I know that if you've got a $30,000 budget to sell a luxury home in Australia, you're spending $1,500 of that $30,000 on REA. If they increase their price by 10%, that's a $150 increase, it's not going to have any impact on you advertising on REA. And you might remember at the very start of the session today, I said we like businesses that can raise their prices without a detrimental impact on unit sales volume. And I think REA meets that criteria. What you'll notice here is the yearly change in depth ad volumes. And you can see the black line, there's been a substantial decrease in the depth ad volumes over time. That's a function of two things, I think. One, it's a function of the fact that we've just come through an election campaign and an election. And we also know that seasonally, the strongest period is yet to come. And also, it's a function of the fact that that REA is migrating agents to the All Premier package, which means fewer individual depth ads, but greater revenue. Okay, this might cause alarm when you first look at this. You can see Domain's national for sale listings has been rising over time, whereas REA's has been going down. Why has that actually been happening? Well, one is total listings in Australia has actually been fairly flat, partly because we've had a booming property market, partly because of the election in the most recent year. And the other reason why you're seeing this, this profile is because historically you would sell your house on just one of those sites. But as the property market becomes more difficult to sell your property in, you're more likely to sell on both. And you'll see these lines converge. Now, all of the growth story that I've just told you hasn't even happened yet. And yet, despite that, if you look over on the right-hand side, earnings per share, EBITDA and revenue have all been growing strongly. How much more strongly will those numbers grow in years to come when those growth factors that I've just described start to show up? Now, we're quickly running out of time, so unfortunately I won't have much time to describe the next company, but the next company that we'd like is a company called Vita Group. Vita Group does it has nothing to do with vitamins and everything to do with Telstra stores and Telstra business centres. They are buying, they've been buying Telstra stores for about 2 times EBITDA, and they've been growing the EBITDA. So they're getting an uplift from the PE arbitrage or the PE expansion, and they're also getting an uplift by growing the EBITDA per store. And what that means is that their return on equity is incredibly impressive. The return on invested capital is incredibly impressive. So they're getting growth on growth. They're buying these stores very, very cheaply, and they're converting them to very profitable stores and getting incremental uplift. And we believe they'll do that not only on the Telstra stores. They're limited by Telstra to only 100 stores, but there's no limit to the number of Telstra business centres that they can have. And we believe that they're going to bring their intellectual property, which is really a very strong sales culture, to those Telstra business centres and continue to grow profits dramatically. So there you have it. That's Montgomery Investment Management's philosophy for value investing. I hope you can take some of what we do and apply it to your own investing. We've got a blog. You can follow us at rogermontgomery.com and you can subscribe there to get locked content, which includes our Best of the Best magazine, and all of the articles we write for newspapers and so forth are published in that. And with that, I'll turn it over to some questions now.
Thanks, Roger. That was a fantastic presentation. I'll let you grab a drink and rest your tonsils for one moment before we answer a couple of questions. As is on the screen, there's an ebook available that touches on what Roger just outlined there. If you're after some more information, just follow the link. You can get lots of good information from the Netwealth website as well. There's some research there on the number of funds that Montgomery Investment Management offer. Now, I'll just get a couple of questions ready for Roger. There's been a few come through, Roger, while you've been talking. I'll lead off with what are your views on Domino's Pizza at the moment?
Okay, so Domino's Pizza is an extraordinary business. There is absolutely no question about that. I would like to have said that it was a core holding for Montgomery. We've never owned the shares because they've always been too expensive for us. Now, why are they so expensive? It's because there are so few high-quality businesses in Australia that you get a very large number of investors investing in a small universe of stocks, and that pushes the PE up. As long as that continues, the PE will stay very high, and what you'll get is a performance that tracks the performance of the business. And so I love it. I think it's an amazing business. I don't particularly like the pizzas, but my taste isn't everyone's taste, and they're doing an amazing job. It's an amazing story for a business that is the franchisee, not necessarily the franchisor. They are the master franchisor and the franchisee. So it's an amazing result. It's an amazing company.
Okay, hopefully that answers your question out there, Sam. So there's a couple of other queries that have come in on the lithium and new metal
sort of new
space.
technology.
Yeah.
So let me talk about that very quickly. There is no doubt that lithium batteries will change the world. Okay, there's no doubt about that. The car changed the world. But how could, in the 1880s, when Carl Benz drove his first horseless carriage past a blacksmith, how would you have picked the winning car manufacturer? In the United States alone, there's been almost 1,300 car manufacturers that have all gone broke. And of the 4 big car manufacturers that exist today, only one of them, Ford, was not bailed out during the GFC by the government. So, it's a dangerous way to try and make money from technology that changes the world. Airlines changed the world. Lots of them have gone broke and most of them don't make any money. Television manufacturers, here's another one. Television manufacturers, there's been more than 2,000 TV manufacturers in the United States. None of them exist today. TV changed the world. So it's dangerous to invest in world-changing technology because it's hard to know what the competitive landscape is going to look like in the future. Often, no one makes any money out of new technology. The only winners are the consumers. So keep that in mind.
Certainly. Good example there with your airline business, Virgin. The next question comes through from Kim regarding IPOs. Does the fund that you manage, or the number of funds you manage, invest in IPOs, and what
Absolutely.
are your parameters for investing in IPOs?
We have great relationships with a couple of investment banks who we think do an excellent job for us, and also have great access to IPOs. We are very interested in investing in IPOs. Just remember, just because a company is new to the stock market doesn't mean it's a new company. A lot of companies have been around for decades, but they're now listing. And we're going to see more and more of that because there's a generational change of ownership going on. Baby boomers are exiting their businesses that they founded. Their kids don't want to take over those businesses, so they're looking to list or trade sale their businesses. So there are a lot of good businesses that are going to come to market, and we're very interested in IPOs. We don't buy all of them, we only buy a few, and in answer to the question, our criteria is exactly the same as what I described. We're looking for bright prospects, high rates of return on equity, little or no debt, and we want the owners to keep some interest in the business over time.
Okay, hopefully that answers your question, Kim. The next query comes from JC regarding the stock Buy My Place. Trades as buymyplace.com.au, I think, and that's is that a threat, do you feel, to REA? It's a discount real estate agent, I believe. Roger, do you know much
There
about
are over 80 websites in Australia that list properties.
Wow.
Many of them list your property for free.
Okay.
And yet everyone still uses REA. Why is that? not only, so a competitive advantage, look, barriers to entry for building a website that lists property are very, very low. Getting market share and having millions of viewers look at your website is very, very hard. So it's easy. There's lots of potential threats, but very few have the network effect that Domain and REA enjoy.
Okay. So it'll be interesting to see that space of the numerous discounts advertisers of property. Following on from that a little bit, is probably the best known competitor to REA is Domain.com. What are your thoughts on that, and do you think it will be spun out from Fairfax in the future?
I think here's the problem. Fairfax's huge problem, and I've written about it extensively in The Australian, in the competing newspaper, but Fairfax's big issue is that they have a linear attachment to their legacy business.
Mm-hmm.
That business is still making money. Okay. And so they're reluctant to break the businesses or separate the businesses.
I see.
We know that their business, the legacy business, doesn't make a lot of money because it's been generating such a low rate of return on equity for such a long time. Okay. If a business perpetually generates a 2, 3, 4, 5% return on its equity, it means that the equity is overvalued. Mm-hmm. The assets on the balance sheet are overvalued. Yeah. Unsurprisingly, Fairfax wrote down the value of its assets just recently.
Yes.
And I warned investors about that years ago. So Domain is a good business. Mm-hmm. It would be great on its own, but it's still embedded alongside a less attractive business. So as a result of that, we wouldn't invest in Fairfax at the moment. We think eventually that legacy business will run down to something that is very insignificant, mm-hmm. And then they will either spin off Domain, or they won't need to spin off because mm-hmm. it'll be the only thing that's making money.
Okay, yeah, which is probably the case almost the current point in time with them. Next query, probably the last question we'll do, is just on Nick Scali. They're the furniture manufacturer, I believe. Do you have a view on on that company?
Amazing business. Anthony Scali, I met when the business floated, and I've known the business since then. Mm-hmm. He's an incredible retailer. He introduced, if you go to a furniture store today, mm-hmm. you pick out your couch, yeah. then you go home, you wait 6 weeks. Okay. He introduced that concept. Guess what that means? No inventory. Mm-hmm. Very little stock in a warehouse that isn't already sold. And so
effective use of capital.
Incredible use of capital. We like the business. Unfortunately for us now, it's a little bit too small, so we can't invest in it. Nevertheless, it is a very high quality business. But just remember, furniture retailers do really well just after the peak of a property boom, because people have just bought a flash new apartment and they're going to fit it out with new furniture as well. They don't want to put their old furniture in a new apartment. So stocks like JB Hi-Fi do well, Nick Scali does well, but if there's a property bust, if there isn't, I'm not saying there will be, but I think there will be. If there is, then there is another side to these businesses, and they tend to see some deterioration in their growth rates, and that can have an impact on the PE ratio.
Fantastic. Okay, thanks for answering those questions there, Roger. That's all we have time for. There's a few further queries came through that we didn't reach, so we'll get to you via email. As always, if you have any further questions about how to invest in the Montgomery Investment Management range of funds, please feel free to contact Netwealth Investments. They're available on our platforms, or you can go to rogermontgomery.com.au and find out more information there. As always, this information was general advice only, not intended to be personal advice. If you do need some help, seek out professional advice. Thanks for your time.